The last reported closing price for GSI Technology Inc., ticker symbol GSIT, was $9.23 on Friday, October 24, 2025, representing a significant negative 19.18% drop from the previous close, with a massive volume of 7.8 million shares traded, which is far above the average. This severe pullback immediately after a staggering surge is the core tension here, and the thing everyone is missing is that this massive volume on the way down, rather than being simple panic selling, appears to be an orchestrated event driven by the company's own actions and subsequent profit-taking by short-term traders. The reality is that the $50 million registered direct offering at $10 a share, a necessary but very heavy price to pay for a company of this size, acted as a gravitational anchor, pulling the stock down hard after its spectacular rise, giving institutional players a perfect entry point at a price that essentially capped the post-news euphoria. This offering, though it brought in much-needed capital to fund their ambitious AI chip plans, simultaneously handed a clear exit sign to the quick-flip retail traders who'd piled in on the Cornell University news, causing the violent correction we've seen. This isn't a story of a failed technology, it's a classic small-cap liquidity squeeze followed by a capital raise hangover, and the crowd is currently split between feeling validated in their profits and absolutely betrayed by the sudden drop. The collective expectations surrounding GSIT shifted dramatically just days ago. The market narrative, especially in the online communities like Reddit's smaller stock forums and on X, was that GSI Technology's Gemini I Associative Processing Unit, or APU, was the NVIDIA killer for specific AI inference workloads. The official announcement confirming a Cornell University study that showed their APU could match the performance of an NVIDIA A6000 GPU while consuming up to 98% less energy for retrieval-augmented generation, or RAG tasks, set the stock on fire. The share price spiked over 200% in a single day, soaring from the low single digits up towards the $18 mark in pre-market trading at its peak. The retail crowd saw a classic underdog AI play, a tiny, overlooked chip company with genuine, independently validated technology that could radically upend the power consumption issues of the current AI infrastructure. This was the hope, the pure expectation of a parabolic move driven by a fundamental technological advantage. However, the reality, as seasoned investors know, is that a small, cash-constrained company with a micro-cap valuation cannot sustain a triple-digit surge without significant dilution or a quick acquisition offer. The stock's immediate fallback to the $9 to $11 range was a direct consequence of the $50 million direct offering priced at $10 per unit. For the management, this was the moment to strike, raise substantial capital to fund the next stage of development, particularly the Gemini 2 APU, while the stock price was artificially inflated by the sensational news. From a business standpoint, it's a shrewd, survival-focused move. You take the cash when it's offered. For the retail investor who chased the peak, it felt like a cold shower. The common belief on social media is that this move was a form of manipulation or a betrayal, a way for the company and institutions to cap the price and dilute the newfound value. This sentiment is palpable. Frustration is mounting as many retail traders who were late to the party or bought near the highs are now nursing heavy losses, feeling like they've been used to provide a capital injection for the company at a price point that has now become a psychological ceiling. They bought the hype of the technology without factoring in the financial fragility of the enterprise and the very real need for massive capital to compete in the semiconductor space. This is the constant tension in small-cap stocks. Great technology is not the same as a great stock investment, especially when the company has a long history of being cash flow negative. Drilling into the trading data, the surge involved heavy short-term trading volume that far outpaced the stock's average liquidity. This indicated two things. First, massive buying pressure from new entrants, both retail and institutional, trying to front-run the AI narrative. And second, the simultaneous selling from insiders and early entrants who saw the spike as an unbelievable opportunity to take profits on a stock that had traded for years in the $2 to $5 range. The short interest update is also interesting, showing a comparatively low short interest percentage of float at around 1.15% in the most recent reported data, which is actually quite low for a volatile small cap. The days to cover figure is below 1, which suggests that the recent sell-off wasn't primarily a short squeeze being fully resolved and then collapsing, but rather a dilution-driven sell-the-news event exacerbated by genuine panic among latecomers who watched their profits or principal vanish. Hedge funds like Marshall Walsh and Goldman Sachs were seen adding shares in the last reported quarter before the huge spike, which suggests some smart institutional money was already building positions, perhaps anticipating a catalyst or simply liking the fundamental tech story at a low valuation. The direct offering then gave these and other institutions an immediate opportunity to secure a large block of shares at a guaranteed price, which is a key reason for the current price stabilization around the $10 mark. The smart money loves a forced equity raise after a major pump, as it sets a clear defensible valuation floor. GSI Technology's core business, which often gets overshadowed by the shiny new AI chip, lies in its high-performance, low-power static random access memory, or SRAM. For decades, they've been a niche but reliable supplier of specialized memory solutions, particularly for the military and aerospace sectors, where their radiation-hardened memory chips are highly valued for reliability in extreme environments. This legacy business is the underlying asset, providing a low but consistent revenue stream, which has been in the range of $5 to $6 million per quarter. This is the reality check part of the story. This is not a billion-dollar revenue company. It's a highly specialized memory firm using that expertise to enter the fiercely competitive AI hardware market. The Associative Processing Unit, or APU, especially the upcoming Gemini 2 and Gemini 3 generations, is their big bet, a novel compute-in-memory architecture designed to handle massive database search and AI inference workloads much more efficiently than traditional CPU-GPU setups. The technology's advantage isn't in training giant models, but in the power-hungry real-time inference phase, particularly for edge computing, defense applications, and large-scale search engines where the cost of electricity is a primary concern. The latest earnings report showed net revenues of $6.3 million and a net loss of $2.2 million in the most recent quarter, which is demonstrating ongoing improvements in gross margin and a reduction in the net loss compared to the previous year, which is a good sign, but the company is still losing money and relies on that legacy SRAM business to fund its AI R&D. The sentiment on X and Reddit is currently a messy mix of diamond hands holders who genuinely believe in the Gemini technology and are viewing this dip as a spectacular buying opportunity, and the angry, disillusioned traders who were caught at the top. The common discussion points revolve around the massive energy savings, the 98% power reduction, and the idea that this technology is a perfect fit for a hyperscaler like an Amazon or Google, or a defense contractor who needs efficient processing at the tactical edge. The frustration is directed at the management's decision to announce a capital raise almost immediately after the Cornell news, viewing it as a move that stalled the natural price appreciation. However, the hope remains pinned on the Gemini 2 tapeout and the prospect of major design wins or contracts, especially with the Department of Defense given their history in that sector. This is the next major catalyst the retail crowd is watching for, a sign that the $50 million they just helped fund is actually translating into tangible commercial progress beyond the academic validation. Without a major commercial contract or a clear sales pipeline update, the stock may very well consolidate around the $10 offering price, a sign that the institutions have taken control of the valuation narrative for the moment. The key frustration to watch is the continued low float combined with high volatility, which makes the stock a difficult trading vehicle for both retail and institutional players, contributing to the whiplash of the last few days. Looking ahead, the tension between the technology's potential and the company's execution risk is what will drive the stock. The expectation is that the Gemini 2 APU will be successfully taped out and then begin to generate early commercial revenue. The reality is that the chip development cycle is long, and securing large-scale orders from major data center operators or defense prime contractors can take years of qualification and testing. The primary catalysts the market will be focused on are the upcoming quarterly earnings release, which will offer a look at the cash burn rate and the health of the legacy SRAM business, as well as any official updates on Gemini 2's development and sampling schedule. An unexpected large contract win, even a small one from a name brand player, would send the stock flying again, because it would validate the commercial viability of the APU architecture outside of a laboratory setting. The major risks remain competition from established giants like NVIDIA and AMD, which can afford to spend vastly more on R&D and have established customer relationships and software ecosystems. GSI's main obstacle isn't the chip itself, but building the necessary infrastructure and software support to make it an easy choice for developers. If they can execute on their Space Development Agency contracts and leverage that momentum into broader defense or edge AI deals, the stock will have a clearer path forward. If you're tracking the stock, pay close attention to the volume spikes on any subsequent upward movement. If those spikes are not sustained by institutional accumulation over several days, it's likely just another short-lived momentum pump. The true buy-in is the quiet accumulation by large funds. Comment below how you weigh the risk of a small company's execution against the potential of a 98% energy-saving technology in the current AI gold rush. The future path of GSIT is not a simple linear projection. It's a tightrope walk between a transformative technology and the grinding commercial realities of the semiconductor industry. And for now, the reality of a necessary capital raise has reset the market's expectations, forcing a colder, harder look at what comes next. The spectacular spike was the narrative of a dream. The $10 offering price is the anchor of hard fact, and the price will be fighting against that anchor until a significant new contract breaks the hold.